Hey everyone, welcome to Alpha Insights. I'm Jeff. Glad you could join us.
And I'm Asher. We've got a lively market rundown for you today. Tech was on the move, and there's plenty to unpack.
Absolutely. Quick snapshot. The tech-heavy indexes led the way, with the Nasdaq climbing as semiconductor and software companies came in with earnings that beat expectations.
Right. And you could really feel a renewed optimism around artificial intelligence investments. When chip makers and software firms talk up AI demand, investors perk up. It feeds into hardware, cloud spending, and future revenue streams.
Exactly. It's one of those reinforcement loops. Better than expected earnings give confidence that AI spending isn't just talk. It's translating into orders for chips and subscriptions for software platforms.
And that's important, because these are the companies pricing in the next big wave of growth. But let's not get carried away. Good earnings don't erase macro risk.
On that note, the Federal Reserve kept a cautious stance on interest rates today. In plain terms, the Fed signaled it's not rushing to cut rates and remains mindful of inflation and the economy.
Which is a bit of a balancing act for markets. Tech rallies when investors expect lower rates on down the road, but right now they're cheering tech on the strength of earnings rather than a dovish pivot from the Fed.
Good point. So part of this rally is fundamental, earnings, and part is sentiment, optimism about AI. That combination can be powerful, but it also means the market could be sensitive to any nudge from economic data or central bank comments.
And speaking of nudges, energy stocks didn't enjoy the party today. They slipped because oil prices moved lower, which tends to pull down energy earnings and investor interest in that sector.
Lower oil tends to cool inflation and headline numbers too, which can influence the Fed's calculus. So there's an interesting interplay. Oil down helps inflation, but if the economy softens too much, that creates a different set of worries.
Meanwhile, healthcare and financials were mixed. Those sectors often respond to more specific drivers, drug approvals, biotech trial results, or for banks, interest rate spreads and loan growth. So it's not unusual to see patchy performance there.
Exactly. Financials, for instance, are sensitive to the shape of the yield curve. If short-term rates stay high, banks can do fine on margins. But if growth looks shaky, loan demand and credit quality become concerns.
Healthcare is a bit of a microcosm. Some names will pop on good clinical updates or cost controls, others lag. That mixed picture keeps investors selective rather than broad brush buys.
So where does that leave the average investor? I'd say keep an eye on two things: earnings quality, not just surprises, but sustainability, and the economic indicators the Fed watches, like inflation and jobs.
Spot on. Also think about exposure to this AI optimism. If you own tech for growth, know whether you're in companies with real AI revenue or just ones riding the tide. The latter can be more volatile when sentiment shifts.
And if you have energy exposure, remember oil swings can come from geopolitics, inventory data, and demand forecasts. Those moves are normal but do affect portfolios and inflation expectations.
One last practical tip: with the Fed staying cautious, don't assume rate cuts are imminent. That changes timing for decisions. Think about duration risk in bonds and how sensitive your growth names are to rate shifts.
All good points. To wrap up, let's hit the key takeaways.
First, tech led the market today thanks to solid semiconductor and software earnings and renewed AI optimism.
Second, the Fed remains cautious on interest rates, so markets are digesting earnings and macro signals rather than expecting immediate rate relief.
Third, energy fell on lower oil prices, and healthcare and financials showed mixed results, so sector selection matters right now.
Nice. That's a great snapshot. Thanks for listening. Keep watching earnings and the economic data. They'll keep steering the market's mood.
Cheers from me as well. We'll be back with more market context tomorrow. Stay curious and stay invested wisely.